Recording has started.
Good morning, everybody. At 11:01, we're going to call to order the Retirement Board meeting for Center County. It is our first order of business to consider approval of the minutes from our meeting on July 30th. Would there be a motion to approve those minutes?
So moved.
Second.
It's been moved and seconded. Any final discussion on the minutes? Hearing none, all in favor say aye. Aye.
Aye.
The motion has carried. Our only order of business today is an update on our status of our fund through the second quarter, and we're delighted to have Mark from PFM joining us today, and we will turn the floor over to you, Mark. Good morning.
Thank you, Commissioner. I'm also joined by Catherine O'Hara, one of my colleagues from PFM. If she hasn't joined, she'll be joining momentarily.
Oh, okay. We don't see her yet, but yep, we'll welcome her when she does. Sure.
Okay, great. Maybe best order of business is for me to share my screen. Does that work for everybody? I believe, did Jason distribute the report? Or?
He did, and yeah, but you could share it as well. That'd be terrific. I don't think it's come across quite yet.
Yeah, it's not giving me the option, unfortunately. It's saying...
And Jason might have to allow you to do that as an administrator, potentially, Jason.
Okay.
Depending on what settings he put in place.
Yeah, I can pull up share my screen, but I can't hit the button share. It's not highlighted.
Are you seeing anything on your end, Jason, that would allow Mark to do that?
No, it looks like all the features should be on for that, but let me see if I can share.
Ah, yeah. In the meantime, good morning, Catherine. How are you?
Good morning. How is everyone?
We're good, thank you. Good.
We can bring up the presentation first.
Catherine, we're just trying to see if I could share my screen. We're working through some technical difficulties right now. You're on mute, I think, Kat.
Well, as you can see, I'm experiencing my own technical difficulties this morning.
Anybody see that? No?
I did for a moment, Jason, but then it disappeared.
Let me see.
There we go.
Got it? All right.
I don't see anything yet on my end.
No?
Oh, Mark, you may have to change your view, and that might have been what was happening, but there is a button that is, where's that at? Down on the lower left-hand side of your screen, there's a little toggle where you can toggle content and people, it says. And so if you're just seeing your screen, you need to change that view, I guess it's the best way to say it.
Mm-hmm.
Is that working at all?
No, I'm not having any luck here. So, Jason, you gave me the authority to share my screen?
You should have authority. I'm not sure why it's not showing up, to be honest. There's no restrictions on that right now.
Okay, yeah, I can pull it up, share screen, but then when I pull up share screen, when I hit share, nothing happens. Unfortunately, it's not highlighted as an option. I can only cancel out of that screen. So I guess in the essence of time, since you have copies, maybe we should just, I don't want to take up any more time dealing with this. So let me go through the deck. I think you have it emailed to you, so this should work just as fine. I will take 10, 15 or so minutes to highlight some updates. This is the same report you saw when we met previously, just with some slides interjected. So, the first slide I'm looking at is slide 3. It says summary of key observations. I think that this is worth reiterating because at the end of the day, this is probably the most important slide in the entire deck. So governance, absence of total fund investment advisor. What does that mean? That means right now you obviously employ one money manager and they manage the entire. You hire 3 money managers and they manage the plan themselves with no oversight from a third party. A total fund investment advisor would, first of all, roll up total fund returns. We took the liberty of doing that again for June 30th. You'll see that in a second. So that's one value add. Another value add is they would make tactical decisions. What does that mean? That means if there's a COVID crisis or a health crisis or a pandemic that we're living through and you want to take some risk off the table, they would enact trades real time to de-risk your plan. So that's just a couple of points I wanted to make in terms of what does a total fund investment advisor do. And they also would have the authority to hire and fire managers. In addition, so if CS McKee or Twin is not holding their own, the total fund investment advisor would have the authority to terminate that manager and replace them with a better performing manager. And maybe the last thing, diversification. So if the total fund investment advisor sees you don't have a lot of exposure to, say, like emerging market equity, they have the ability to hire an emerging market equity manager, as an example, or high yield manager to build out a more diversified portfolio real time. So that's the value add of an oversight. I know you all have so much going on, and that would take that off your plate in terms of the governance of the county retirement fund to some extent. The other thing worth noting down in portfolio, lack of diversification. I think I just mentioned that, but I'll get into that in a second. That means you do not have exposure to asset classes such as high yield. You have very, very small exposure to emerging market equity. You do not have exposure to real estate. So I'll get into that in a second. Absence of index funds. I think we talked about that last time. Obviously, you hire 3 managers today and they manage your entire portfolio. Index funds would drop the cost of the underlying managers. Index funds have been very challenging to beat, especially in domestic equity. And we have updated metrics there. And I know Commissioner Higgins had a question last time we were together, so we updated that analysis per his comment. So performance, looking back, the total fund has underperformed benchmarks, as you're probably well aware, and underperformed peers. We have updated that through 6/30, and I'll get to that right now. So I'm going to flip ahead to slide 6. 5 is March 31st, 100 million. 6 is June 30th, 114 million. Everyone's still with me. Any questions before I continue to move through these slides? We're good? Okay, here, no commentary. I'll keep on going. Slide 7 is your performance through March. You were negative 16%. So on an absolute basis, obviously, the stock market took a significant hit in the first 3 months of the year, but on a relative basis, you underperformed by 2.7% and almost 3% for the trailing 1-year period. Again, this is rolled up returns. So this is all your managers rolled up into one return. This is the value of an investment advisor at the aggregate level. 6/30, here it is on the next slide, slide 8. So unfortunately, your underperformance has actually increased in the most recent quarter. The absolute number is better. You're only down 4%, but you can see now you're missing the benchmark by an even 3%. It was below 3% in the first 3 months of the year. So again, the absolute number obviously is better. The stock market recovered in the second quarter, but your relative underperformance has increased. And I'll get into why in a second. And you can see your 1-year number is now below benchmark by 2.5%. So I think this is a very important slide, slide 8, because again, my understanding is you don't have a total fund investment advisor that's rolling up the manager's returns, and that's what you're seeing here on slide 8. So I think it's an important metric to be aware of as a county retirement fund board member. I'm going to flip ahead. All the way to slide 16. So I got into this a little bit on my opening remarks, but diversification, what do I mean? You have exposure to what's in the green rectangles, if you will. You don't have exposure to what's outside. So high yield bonds. High yield bonds have done really well looking back, and they're doing fairly well this year after the crash. Emerging market equity, right above small cap. You have very, very small exposure to CS McKee. Emerging market equity is a part of their international equity product, but it's very minuscule. Real estate, you don't have exposure there. So I think it's worth, again, that's the value add from an investment advisor. They would see where you don't have exposure, and they would add asset classes when they think it's prudent to reduce the volatility of your plan. Slide 18, I think, is important. Slide 18 shows you intermediate term. So what is this? 4.7% if you look in the middle of the slide. What does that mean? That means if we take your current asset allocation mix, and you see it in the pie chart, that's what's in your investment policy statement, those targets there. If we take that and we use PFM's projections for those asset classes, we're projecting your plan to return 4.7% in the next 5 years. That's what intermediate term is. Long term is 30 years plus. So, you need to look at that number and say, I know your actual assumption is 7.5, so it's well south of 7.5, 4.7. What else can you be doing as a county retirement board to potentially enhance that return of 4.7? Again, that assumes the market doesn't go gangbusters up or gangbusters down. It's kind of normal kind of returns, if you will. In that environment, we're projecting a return for your plan south of 5% for the next 5 years. And then on slide 21, you can see what does that do from a funding perspective. If you look at the table on slide 21, you're roughly 90% funded today. Over the short term, if you don't do the top row is if you don't do anything. The bottom row is if you implement a more diversified portfolio. So higher emerging market equity, real estate potentially high yield. So that's what diversified means. If you look all the way over the long term, your funding ratio goes all the way down to 66%. If you don't have a fully diversified model, it still goes down, but nowhere near as down as what's shown in the top row on slide 21. So why did your fund underperform in the first 6 months of the years? It's slide 27. We can introduce 27 by looking at 26 briefly. 26, what's highlighted in red is what I'm going to talk about now, and that's your two large cap active managers, CS McKee and Twin. If you look at 27, this is through March. Through March, unfortunately, neither manager protected capital. They both lost more than the benchmark in the first 3 months of the year, and you can see that theme unfortunately continues for the 1 year and 3 year period. And this is why you hire an active manager, is to minimize losses. Unfortunately, that did not happen. Slide 28. So we did update this as of June, and unfortunately, the theme continues. You can see, the benchmark is still negative through June, 3%. I think you know this already. CS McKee for the year is down 10%, and so is Twin. And unfortunately, it's not much better if you go out 1 year. The trailing 12 months ending June, they're both underperforming by quite a margin. 3 year, same story. So, the number in parentheses, just so you understand, I think I mentioned this last time, but just so you understand, the number in parentheses is how they're doing relative to their peers. So if you look at the year-to-date column, CS McKee, the number in parentheses is 90. That means for the first 6 months of the year, they've only outperformed 10% of their peers. Twins outperformed 11% of their peers. The lower the number, the better. And unfortunately, if you look at the 1 year period, their peer rankings leave something to be desired, to say the least. So that's June 30th update. That's one of the major reasons why you're trailing your peers at the total fund level and trailing the benchmark. Is your two large cap active managers are missing the benchmark. So we talked about index funds last time, and you can see it starting on 33. 33 is through March. Maybe we should flip ahead to the next slide. The next slide is labeled peer group analysis as of June 30th. It says iShares Core S&P 500 Index Fund. Last time we were together, Commissioner Higgins was saying, let's make sure we're showing index funds relative to a universe that's net of fees. And that's what this is. This is all mutual funds. So when mutual funds input their data to this database that PFM subscribes to, they input it net of fees, their returns. So again, everything here is apples to apples. An index fund in large cap domestic equity, which is what we're looking at on this slide, is right around median. 1 year, it's the 45th percentile, 3 year, 45th, 5 year, 40th. So it's a little better than median. We think this is an asset class where you can save some money and index. Maybe not the entire thing, but undoubtedly a portion. We also looked at calendar year returns on the next slide. This is calendar year returns, and you can see 2019 38th percentile, 2018 45th percentile, 2017 51st percentile. So kind of right around median. This is looking at an index fund in large cap relative to their peers, and that's what you want. You want an index fund that's going to be kind of around the median, and then complement that index fund with active managers to outperform. Is the thought. So hopefully that makes sense. Let's move on. If I hear no questions, we can continue to move on. In the essence of time, maybe we want to jump over small cap. The takeaway here is Emerald's doing quite well. We can look at a slide if you like, but let's see, slide 41. Emerald's doing fine. If you look at the year-to-date basis, unfortunately they are negative. The benchmark's negative 12. They're negative 4. The lower the number, the better in parentheses. So they basically outperform 96% of their peers on a year-to-date basis. So kind of off the charts performance. Why? You might be asking yourself why. When I think of Emerald, I think of a growth shop. A growth shop means a company that likes to buy stocks in the information technology sector and healthcare sector, and those are the two best sectors. Google, Amazon, Facebook, they're all kind of leading the way in this stock market rally that we're living through. And they're big believers in growth stocks. So that undoubtedly has been a tailwind to Emerald in this product. But I think in the essence of time, we can jump ahead. Maybe I'll show one more slide, which is 45. 45 shows you how the index has done. It's a little better than median as of March. And if you flip the page after that, it's labeled peer group analysis as of June 30th. It's better than median for the trailing periods. If you look one slide ahead of that, this is calendar year returns. It's better than median usually. All that being said, you found a manager that's outperformed the index by quite a margin. So maybe you do use an index fund here, but I wouldn't take the entire allocation away from a manager that has shown the ability to outperform. International equity. Slide 49. So you only have one manager here on slide 49, CS McKee International Developed. And the word developed is important. That was my comment earlier. When you see the word developed, that implies they don't really buy stocks too much in emerging markets. They buy stocks in developed countries overseas. Well, that's a hole in the portfolio. The emerging market equity has performed quite well. Slide 50 is an update of 49. Why don't we flip ahead to 52? This is through June 30th, 52. And unfortunately, this is another manager that's really hasn't done as well as you would have liked. Look at the year-to-date column on 52. Again, international stocks have struggled this year. They're down 11% through June. Unfortunately, CS McKee's down 15%. If you look at the 1 year period, international stocks are down 4%, and CS McKee's down 10.8. And the number in parentheses, again, I think you know this now, the lower the number, the better. So for the year, they've only outperformed 16% of their peers. And the benchmark we have them against is a developed market benchmark, MSCI EFA. That's a developed market benchmark. They have, let's call it 4 or 5% outside of developed, CS McKee does. But the performance, again, has been a headwind to your total fund return that we looked at earlier. If you look at slide 53, it's calendar year returns, and the past 3 calendar years they've performed below median. And their volatility on 54 and 55, their standard deviation, that's how volatile the returns are. The volatility is above the benchmark, which means they're more volatile than the benchmark. So if you look at slide 56, this is an index fund in international equity. And you can see it's right around median. As you get out to 5 and 7 and 10, it doesn't do as well as the median. An index fund in international equity, we did update it through June. On the subsequent slide, it's labeled peer group analysis as of June 30th. The 1 year period, it hasn't done that well. 62, an index fund in international equities only outperformed 38% of the peers. 3 and 5 year and 7 year, it's kind of right around median. So this is an asset class where we think active management can add value, but an index fund should still be used for a portion of the international equity allocation. But we don't think the index fund and international equity should have the same weight as domestic equity, but we think there should still be an allocation to index funds and international to capture the market at a low cost. And then you can see the peer rankings for the calendar year basis on the subsequent slide: 58th percentile 2019, 61st in 2017. So 2 of the past 3 years, it's underperformed the median an international equity index fund has. And again, per Commissioner Higgins' comment last time, this is shown versus all managers' net of fees. Fixed income, the last asset class, 60 is March 31st, so we can skip ahead to 61. You only have 1 manager here. One thing we're not sure why is if you look at 62, you have exposure to CS McKee's what's known as their intermediate aggregate product. And if you want to flip ahead to 63, it's, the product you have is the top row. They're up 4%. What we don't understand is why you don't have exposure to their CS McKee's aggregate product. The difference is CS McKee aggregate is a more diversified fixed income product, and it's performed better than the product you have exposure to at Center County. So I don't have an answer why you're using CS McKee intermediate versus CS McKee aggregate, but this is another example of how a total fund investment advisor would pick up on something like this and bring it to your attention. Because again, CS McKee aggregate is a more diversified fixed income product, and if they're the only fixed income manager, you would want a more diversified solution. So just wanted to bring that to your attention.
Mark, if I could jump in for a quick question. Jason, would it be possible next time you speak with somebody from CS McKee to ask them about that?
Yeah, absolutely.
Okay, thank you.
Performance for the intermediate aggregate product which you have exposure to is done fine. I'm looking at slide 66, which is through June 30th. So as a standalone product, it's done fine. Year to date, it's 53rd percentile. So when I think about this product, I think it's fine. But is it the right product at CS McKee to be investing with? But CS McKee intermediate aggregate has done okay relative to the benchmark. Volatility is kind of below the benchmark or right around it. What is important though is to look ahead to 69. 69 now we get into index funds. Now we are not big believers in index funds when it comes to fixed income, to cut to the chase. You can see, it's really struggled. The index fund has over the longer term, the 5-year and 7-year period. It's been very, very easy to beat the index fund in fixed income. This is as of March. If you flip ahead to 71, which is calendar year returns, the index fund has scored pretty poorly in 3 of the past 4 calendar years. 2019, 65th percentile, 2017, 77th percentile, 2016, 86th percentile. So we think this is an asset class where active management can truly add value, and it's demonstrated with the prior calendar year returns. So that's the update in terms of Center County's performance and why, you've been lagging the benchmark and lagging peers. Are there questions before I take last couple minutes to mention a couple other points?
I do have some feedback and questions, Mark, but I think it would make sense once you're, all, it's more overarching questions. So I don't have any at this point, but are there any others before Mark proceeds? Okay, it sounds like you can keep on going, Mark.
Okay, yeah, I'm looking at slide 73, Commissioner Pipe. So this is just specific to CS McKee. I think it's worth looking at this because you have significant exposure to this firm, obviously. The bottom chart shows you their assets. They used to be a $14 billion firm back in 2012. If you look to the far right, they're now $7.6 billion. I did get an update right before this call. They're now $7 billion as of the end of the second quarter. So that's interesting to note. I think you know this. They sold 88% of the firm to a Chicago-based asset management firm, and they've had turnover recently, which we talked about, I think, in a meeting, in our last meeting. Twin on slide 74 is a $1 billion firm. It's a very small firm based outside of Pittsburgh. I think you know that. It's about 10 people. And Emerald on slide 75 is about a $3 billion firm located in Lancaster County. I just wanted to bring that back to your attention. Fees are on 77. Your total investment manager fees on a weighted average basis is 34 basis points. I think we can flip ahead. The section labeled total fund oversight, various options, 82. We brought this to your attention last time, and this kind of walks you through the two models that are prevalent in the PA County space. One is a consultant that gives recommendations, which has been losing momentum, and the other one that's been gaining momentum is a discretionary approach. I'm looking at slide 84. The difference is here. If you look to the far right on slide 84, a discretionary investment advisor has the ability to select managers real time. So if they think high yield is going to do really well, they have the authority to implement a high yield manager right into your county retirement fund. Or if they're concerned, like the first quarter, that the market's going to significantly sell off, a discretionary advisor has the ability to de-risk the portfolio. So that's gained significant momentum. Discretionary management has in the PA County space. And clients' time or responsibility on slide 84, one could argue with a consultant, it's not going to change much if you hire a consultant because your county retirement board is still going to make all the final decisions. You're still going to have to say yes or no. You're still going to have to interview managers. Under a discretionary approach, I think your job as a county retirement board is simplified because you're looking over the shoulder of the overarching investment advisor and making sure they're executing on their overarching investment philosophy. So you're laser focused on the overall investment advisor and the total fund returns, as opposed to all the underlying managers, domestic equity, international equity, fixed income, etc. Those are the two models. I'll stop there and just transition very briefly to PFM, and then we can entertain questions. 89 I think is important. 89, we have 14 billion, closing in on 14 billion, I should say, in discretionary assets. Slide 90, 165 of our 229 clients are in the governmental space. This is PFM's bread and butter. Slide 91, we believe, this is our investment philosophy, we believe in active and passive management, we believe in diversification, and we believe in dynamic asset allocation. So I think I mentioned all those points to you, but I thought it was worth reiterating. 92 on the bottom, these are all the trades we've implemented across our clientele. I'm obviously not going to go through all these, but the important takeaway here is we execute about 3 or 4 or 5 trades a year. In 2020, we've been more active because of the COVID crisis. So if you look at the one bullet point, March 2020, we removed the equity overweight in our clients' portfolios and implemented underweight to equity and overweight to fixed income because of the COVID crisis. We took about 20% of our clients' equity exposure off the table. I think but there was a 35% sell-off earlier this year. And we started adding back to equity once we gained more comfort that the worst was behind us. So just an example I wanted to highlight. I think 94 is important. 94, I'll go through this very briefly, but 30 basis points on the bottom, that's the underlying manager fee for a sample portfolio at PFM. So we do not buy stocks and bonds like your incumbent. We buy managers. It's an important distinction. So domestic equity, this is just to show you kind of our philosophy. Domestic equity, 86% is passive. Look at the expense ratio. It's very cheap. International equity, look at the passive row. 40% of international equity is passive. Look at the expense ratio. It's very low. So in both, then that's consistent with my earlier remarks, I think, higher passive where you can save some fees and then complement the passive with active. In fixed income, it's the opposite. Look at the active under fixed income. It's 78% of our clients' fixed income assets are active. And then small passive allocations. So again, I just want to highlight that this is kind of a sample portfolio. And then we have performance back here on slide 95. So this is real client performance. This is not picking up our best performing clients and sharing it with you. This is all of our clients. The top box is all of our clients that are invested roughly 70% in the equity market and 30% in the fixed income market. And then the bottom table is all of our clients that are invested roughly 60% in the equity market and 40% in the bond market. So I'll stop there. I want to be sensitive to your time and entertain questions.
Okay, thank you very much, Mark. So just in terms of the, just some thoughts for the high yield bonds, how could we go about getting into that market? Would that be bringing on another manager? Is that something that's one of our managers could currently do? How would a county go about getting involved in that?
Yeah, so my understanding is your incumbent manager does not invest in high yield in the fixed income space, so you would need to go outside of the three managers you have exposure to, Commissioner Pipe, to add high yield. So you don't have an investment advisor today. So I was going to say lean on the investment advisor to bring you their best options, and then you, the county retirement board, can make a final decision. But the other option is obviously to hire an investment advisor, and that investment advisor could have the authority to hire the high yield manager. So those are the two models that are out there. But again, without an overarching investment advisor today, not sure how you would go. To be quite honest, I'm not sure how you would go about doing that. To cut to the chase.
Okay, no, but you answered the thing I was curious about is it within the options we currently have? It's not, so we would have to augment the portfolio with another, or augment our current managers with another entity. So that was helpful. Thank you, Mark. And then also one of the things that we've discussed before, it was an idea that I had just from looking at active versus passive, but I've been coming to the conclusion that passive management, especially in high cap, or passive investment in high cap is worth looking at, because you can secure your fees, you get a lower fee, and you also enjoy the changes of the market, where with picking and choosing different managers, it's you risk. I think there's a little bit more risk there, and so. But in terms of an RFP or some sort of process for allowing different passive firms to, send us quotes, or again, I think it would have to be an RFP process. Is that something that you do? Because I know in terms of the RFP process, but I think one of the challenges would be that you also provide that service, so there may be an interest from from PFM in solicit or responding to that RFP. And if that was the case, we probably would have to find another entity to do the RFP if you were interested in doing that, because we'd want to make sure that was separate. But is that something that you do, the RFP process, or if not, if there are other entities that you're aware of that you could maybe refer us to? I think we'd appreciate that.
So, when PFM is involved in the county space and the municipal space, we manage slash consult on the entire portfolio. We don't come in on an episodic basis and look at an asset class and say you should issue an RFP for passive. You need more passive exposure. It's more from a total portfolio perspective and an ongoing recurring nature. I'm not aware of firms that are out there that would come in and just facilitate an RFP for a particular asset class. I haven't seen that done. You as a retirement board obviously could issue an RFP for a passive manager or high yield manager and would have to run the process on your own. But I'm not aware of other firms out there that come in and say, we'll run this process for you. All of our competition is really involved at the total fund level as opposed to the individual asset class level, if that makes sense.
It does completely. I'm not surprised by that answer. It would be a very, very niche market to be involved in just doing the RFPs. The business side of things makes more sense to be replying to the RFP. RFP. So I thought that was the answer. I figured I'd ask anyway. So So if we would need to do if we would want to do an RFP for passive management of high cap, we would have to initiate that and run it. So okay, that sounds good. Those are the only questions I had, the feedback I had, very thorough, but again, we'll open the floor to anybody else who wanted to ask questions and feedback and discussion.
I'm good.
Yeah, it was very thorough. I
Okay.
appreciate the effort and the well-organized slide deck.
Mark, I have a clarification on a term. You had talked about if we have outsourced CFO kind of person, that they would do a roll-up of earnings or something. I can't remember the exact term that you used, but if you know what I'm speaking about, could you explain that a little bit more clearly, please?
Yeah, so one of the overarching goals, one of the overarching responsibilities of a total fund investment advisor is to take the returns from CS McKee, Twin Capital, and Emerald every single quarter, if not monthly, and roll it up to a county total fund investment return. So you, as a county retirement board, can see how you're doing in the aggregate relative to your actuarial assumption of 7.5%. So that's best practice, and that's what we see across the Commonwealth. I know you do it a little different. You hear directly from the underlying manager in a silo, but one of the big value adds of a total fund investment advisor is to interface with those managers and aggregate the returns on your behalf.
Is aggregating the returns the same as what we do on an annual basis, where we do a sort of, we call it or Rich called it a blended, where you take the earnings from each of the fund managers and then weight it according to their percentage of the portfolio, and then determine what your sort of aggregate earnings are among all the funds? Is that the same sort of a thing?
It'll probably get you on the rough ballpark. It's probably not going to be an exact science. You really need to understand the cash flow situation at the underlying managers in terms of the ins and outs. But what you just described will get you roughly in the ballpark, because I understand that's probably what you provide to your actuary, because I know calendar year returns are in your actuarial report. But yeah, so our what I was alluding to would be more of an exact figure for your edification. Yeah, and it will be quarterly. Some of our clients require monthly total fund investment returns.
Okay, thank you for that.
Mm-hmm.
I didn't have any questions, but I did want to thank Mark and Catherine for joining us again today. I got them the second quarter results a week ago, and they were able to incorporate those into this new report and add some additional context to it. So I do appreciate that turnaround for us as well today.
Thank you. Yeah, we're happy to do it, And I just want to let you know that, PFM would be excited to potentially, work alongside the Center County Retirement Board if if you view that to be a value add. We certainly do in terms of total fund investment returns, further diversification, real time protection of capital during a down market like we just experienced in the first quarter. So there's definitely value that we can bring to the table. And again, just wanted to voice that it would be a great opportunity for us to work together if that avails to yourself.
Okay. Thank you very much, Mark. Thank you very much, Catherine. If we don't have any other questions or discussion, we will look to adjourn the meeting with the note that we will be meeting again, potentially maybe before that September 24th date for a members, or we wouldn't have any advisors or I should say managers with us. It's a public meeting; anybody can join us, but it wouldn't be a quarter. We would meet before the quarter 3 update. So if we do that, we'll let all of our retirement board members know. But again, we will stay in touch with you, Mark and Catherine, about our plans going forward. This is very helpful for us just to get this information, review it. But there are certain trends that are emerging that I think that we do as a retirement board need to take action on and be aware of. So again, thank you both very much. If there's no other business, we'd look for a motion to adjourn.
So moved.
Second.
Been moved and seconded. Any final discussion on adjourning? If there's none, all in favor of adjourning, say aye. Aye.
Aye.
Aye.
Okay. Thanks, everybody. Have a great one.
Thank you. Be safe.
Thank you.
Thanks so much.